Welcome to today's Daily Brief. This explainer is all about breaking down the S&P 500, its structural dominance, how risk actually works, and some really actionable intraday strategies. Whether you're in the trenches actively trading or just kind of want to understand the invisible forces driving the world's biggest financial engine, well, you're absolutely in the right place. Let's get into it.
Okay, let's just quickly breeze through our agenda for today. First, we're unlocking the S&P 500's history. Then we'll look at why U.S. markets lead the world. After that, managing risk like a pro, decoding those tricky intraday patterns, and finally, the big one, following institutional smart money.
All right, Section 1, Unlocking the S&P 500, looking at a century of historical market resilience.
To truly appreciate this market, we really have to respect its historical weight as a literal wealth-generating machine. Just think about what it's been through. Since 1896, the market has faced exactly two major global pandemics and two world wars. Right in the middle of those crises, it probably felt like the world was actually ending, right? Sentiment was just catastrophic. And then add to that the total devastation of the 1929 Great Depression, along with, get this, a staggering 25 separate economic recessions. That is 25 distinct periods where economic growth literally went backward, unemployment spiked, and pure panic gripped the entire financial system. Yet despite all of that chaos, the S&P 500 has still delivered historical annual returns of around 10% over nearly a century. Just take a second to think about that. Through wars, pandemics, depressions, the overarching structural trend of the U.S. market has been relentlessly upward. This isn't just some random statistical fluke. It's literally a built-in feature of the system itself. Moving right along to Section 2, U.S. markets lead the world and the widening macroeconomic divide. So that 10% historical return, it doesn't just happen by magic. It needs a massive economic engine, and the primary engine of the S&P 500 isn't a mystery at all. It's heavily dictated by sheer U.S. liquidity and the super reliable growth rate of corporate profits. When you're analyzing the market, your absolute first focus should always be on those two pillars. Is capital flowing freely into the system, and are the top companies actually expanding margins and making money? When the answer is yes to both, the trend is undeniably bullish. Now, to put this into perspective, let's look at Germany, traditionally the total economic powerhouse of Europe. Well, Germany's share of global GDP has actually contracted for 10 consecutive years. It's sitting at just 4% right now amidst this broader European deindustrialization. It's a pretty stark wake-up call, honestly. While the US just keeps innovating and pumping in liquidity, major European economies are frankly slowing down. And the gap between US economic expansion and European stagnation, it isn't shrinking, it's actually widening. And that is exactly why the US stock market dictates global momentum. When you're looking for the absolute center of gravity in global finance, it is unequivocally the United States. It's where the liquidity is, it's where the growth is, and because of that, it's where the smartest money in the world goes to work. Which brings us to Section 3, managing risk like a pro and shattering the myth of the high win rate. Okay, so understanding the big macro picture is great, but honestly, it won't save you if you don't know how to actually survive the daily battlefield of the market. Let's look at the reality of trader success here. Imagine three traders. The first knows the fundamentals, but, has completely average execution. The second trader brags about this massive 60% win rate, but totally ignores risk. They just let losing trades run until their account is completely wiped out. But the third trader? This person only wins 20% of the time. But because they ruthlessly cut losses and totally optimize their risk to reward, they're the one virtually guaranteed to succeed. It sounds completely counterintuitive, I know. Your ego desperately wants that high win rate, but your bank account, it strictly requires risk control.
A lot of people view volatility as this massive threat. But when you apply strict risk management, that exact same volatility actually creates mean reversions that you can exploit for incredibly precise entries. When you truly control your risk, you aren't afraid of the market swinging wildly. You actually welcome it. Because those sharp pullbacks in a really strong uptrend, that's exactly where you find your low-risk, optimized entry points.
You definitely don't have to be the passive hoarder. You know the type. Hiding in a cash bunker for years, just waiting for some catastrophic 20% market crash so they finally feel safe buying in. Instead, you can be a proactive risk manager. You can actively trade strong uptrends totally safely, provided your risk management is, flawless. By maintaining a strict risk-to-reward ratio, you don't need a once-in-a-generation market crash to make a profit. You literally just need discipline. Let's jump into Section 4, Decoding Intraday Market Patterns. This is our hour-by-hour S&P 500 playbook.
All right, this is where all those theoretical concepts hit the reality of the daily market clock. Let's zoom way in. We're using European trading hours here to map the shifting psychology of the day. Notice how the market completely changes personality? At 3:30 p.m., retail orders just flood in. By 5:30 p.m., the European markets are closing up. Then we hit this weird dead zone right before the algorithms wake up at 8 p.m. And that rapidly accelerates right up to the critical final hour at 9 p.m., when the massive institutions basically take the wheel. Understanding this rhythm, it's literally like having a roadmap for the market's mood swings.
Get this. During that first hour and a half, when the market opens and all that less informed retail money enters, the market actually moves completely laterally about 70% of the time. It's not establishing a clear trend at all. It's just absorbing all those messy, emotional market orders and trying to find its footing. So if you're trying to catch some massive trend in the first 90 minutes, you're fighting the statistical reality that the market is mostly just chopping sideways. So what's the play? Well, for intraday traders, it's this highly repeatable pattern right here. The S&P 500 routinely dips right around the time the European markets pack up for the day, so between 5:30 p.m. and 6 p.m. on our European clock. This happens because overseas liquidity exits for the day, which temporarily shifts the balance of the market. Recognizing this reliable dip gives you a fantastic, actionable clue for your daily playbook.
And right following that dip, the market basically just goes to sleep. From 6 p.m. to 8 p.m., we see this distinct stall. Volume totally dries up and big moves are super rare. But then, boom, from 8 p.m. to 9 p.m., trading volume violently surges back. The automated algorithms boot up, they start executing their program directives, and that sets the stage for the absolute climax of the trading day.
Which perfectly tees up Section 5, following institutional smart money, the absolute golden rule of financial markets.
Okay, this brings us to the most important hour of the day. Honestly, if you take only one thing away from this entire explainer, let it be the profound power of this final hour. Between 9 p.m. and 10 p.m., the massive institutional players enter to dictate the daily close. We're talking mutual funds, pension funds, entities moving billions of dollars. And guess what? They do not care about retail noise. They move the market to the exact levels they require. Our only job as smart market participants is to step aside, watch where their massive footprints are leading, and just quietly follow them. We don't predict, we follow. So I want to leave you with this provocative thought to kind of analyze your own system today. Are you letting your ego chase a high win rate? Or are you ruthlessly managing your risks so you can actually survive long enough to ride the coattails of the institutions? Look, the market has been generating wealth for over a century for the people who respect its rules. Manage your risk, follow the heavy liquidity, and let the smart money do the heavy lifting for you. Thanks so much for joining me on today's Daily Brief, and I'll catch you next time.